What if I told you that you could retire at 65 with $1 million, generate the income you need to actually enjoy retirement, and here's the part that nobody believes at first, never touch your principal? Most people think retirement is a race against a melting ice cube. You spend down your savings and hope it doesn't disappear before you do. But what if retirement didn't have to feel like a countdown? What if your money could support you without relying on market returns, without complicated products, and without crossing your fingers every time the stock market has a bad day? Today, I'm going to walk you through exactly how that works. Not hypotheticals, not theories, real practical income strategies that we use every day to help people retire with clarity, confidence, and control. So let's dig in, see how we can retire with $1 million or more, produce reliable income, and keep your principal intact for life. When people first come into my office at 65 with $1 million saved, almost every one of them asks the exact same question. And it doesn't matter whether it's $1 million or more than $1 million, but what they usually ask is, do I have enough? And how do I make sure it lasts? And that's a completely reasonable question, because most traditional financial advice accidentally sets people up for stress. You've probably heard the old 4% rule, right? Take 4% out of your portfolio each year, increase it for inflation, and hope the market cooperates. But here's the problem. That rule was created in the 1990s when interest rates were higher, market valuations were lower, and retirement timelines were much shorter. Today's retirees can easily live 25 to 35 or more years. That means you're supposed to live off of your savings for as long as your entire career. And the idea of spending down your principal while hoping the market bails you out, that's not a plan. That's a gamble. What you need instead is an income system, a strategy that uses the tools available today to create reliable, repeatable income without pulling down your nest egg. And the good news, you can absolutely do that with $1 million or more. Now, it doesn't have to be $1 million. It could be less than $1 million, but I like the round number of using $1 million. So we'll start with the fundamental shift that most people need to make. Retirement is not about maximizing returns. It's about maximizing reliable income. You don't retire on growth. You retire on income. Your goal is not to grow your million to 2 million. Now, that would be nice, but your goal is to use that million to generate steady, predictable cash flows so you can spend confidently. But, and this is the important, you want to do that without putting your principal at risk and without relying on market performance. Why? What we found is that a lot of people, psychologically, they don't like the idea of their money depleting or going down while you're spending it. Okay, so here's the framework we'll use. One, we'll use dividend-paying stocks, but not ride the roller coaster stocks. We use high-quality dividend growers that historically increase income even during slow markets. Then we want to use some other fixed income ideas, maybe structured banknotes, designed to create predictable income with built-in downside buffers. You could use an individual bond ladder, structured to eliminate interest rate risk, not create it, and to lock it in and lock in the known cash flows. And then fourth is we want to create that cash flow bucket, timing the right income sources at the right time so the market can never force your hand. This isn't a magic trick, it's engineering. Let's walk through each component. Now, most of you have heard dividend stocks and automatically think more risk, but not all dividends are created equal. The strategy I'm talking about focuses on long-term dividend aristocrats and growers, companies with 20 to 50 plus years of increasing dividends, strong balance sheets, lower volatility than the overall market, and historical dividend that increases even when stock prices fall. Think of companies like Johnson & Johnson, Coca-Cola, Procter & Gamble, Pepsi, McDonald's. These companies have weathered recessions. They've weathered inflation, wars, pandemics, and still increase their dividend. Now, again, make sure you meet with your financial advisor or go through your financial portfolio and meet with your professionals to make sure you're making the right decisions. Now, here's why dividend income matters. Let's say part of your $1 million, maybe $300,000 to $400,000 is placed into the dividend or a diversified dividend income strategy. If the average dividend yield is around 3%, that portion alone can generate $9,000 to $12,000 per year of income. But here's the magic. Those dividends historically grow. If dividend income rises 5 to 8% per year on average, your income rises even if the stock price doesn't move. This is why a dividend strategy can provide inflation-fighting income without requiring you to sell shares. You're not hoping the price goes up, you're collecting checks. Now, that doesn't mean you'll miss out on any of the growth. You'll still have some of the growth, and these stocks do appreciate over time. They're just not going to grow as fast as some of the tech stocks that are growing right now, or some other stocks that might grow in the future. They're typically going to be a little bit slower growth, but very consistent on a long-term average. Now, let's look at another part that you can generate income with, and that's something called structured income notes. Now, these are usually income notes through the big banks, and I know these might sound complex, but they're fairly new to the masses, but they've been around for a long time. Now, they're not nearly as intimidating once you break them down. A structured income note is simply a contract with a bank that says you get paid a set income amount, often 7 to 12% annually, depending on market conditions, and then the income continues as long as the underlying investment stays above a certain level. Now, this is just one type of a income note. There are lots of different types, but even if the markets fall, you often still get paid as long as the drop isn't catastrophic. So what makes these powerful is the buffer. It's like saying you can have this income, and even if markets drop 20 or 30%, you still get paid. Are they right for everyone? No. But used correctly, they can be a high income sleeve in a retirement plan. Now, here's an example of how structured notes might work. Let's assume you have $200,000 or $250,000 of your million in a combination of structured income notes. If those notes pay even conservatively 8% annually with $250,000, that's $20,000 per year in income. No selling of principal, income even during moderate or market declines. For many retirees, this replaces or reduces the need for high-fee mutual funds or risky portfolios. Now let's dive into a bond ladder. Now, this is income you can count on. Most retirees understand bonds, but also fear them because of what's happened in the last few years. Bond losses, interest rate spikes, confusing headlines. But here's the truth. Bonds didn't fail. The bond funds failed. A bond fund never matures. It just keeps reacting to interest rates. An individual bond, on the other hand, is simple. You know exactly when it matures, you know exactly what interest rate you'll receive, and you know exactly how much principal you get back. That's precisely what retirees need. We often create laddered bond strategies that occasionally yield 5 to 6%, depending on the environment. So let's give you an example of how a bond ladder could work. Let's say you have $300,000 of the million that goes into a ladder of a high-quality individual bonds. Some mature in 1 year, some in 3 years, some in 5 to 7 years, each paying reliable interest. If those bonds average 5%, you're generating $15,000 per year in income, guaranteed return of principal at maturity, and confidence during volatile markets. Remember, confidence is a form of income. When you know your money is coming in, you spend more comfortably. So let's put it all together. Let's walk through an example of how maybe a 65-year-old could structure their $1 million. And again, this isn't a recommendation. This is just a simple teaching example. So let's say I have $1 million. I put $350,000 in the dividend stocks. I'll generate roughly $11,000 per year. Plus I'll get some growth. I'll put about $250,000 in the structured bank notes. That's going to give me about $20,000 a year. Build out a $300,000 bond ladder. That'll give me about $15,000 a year at 5% interest. And then just put some cash reserves set aside, about $100,000, which could generate $2,000 to $3,000 if it's in the money market. Now, this example produces about $48,000 to $50,000 per year in income, and your $1 million stays intact. All that is dividend and interest without drawing any part of the principal. Now, if a married couple is also receiving Social Security, that may add $35,000 to $55,000 per year, depending on timing and benefits. Suddenly, your income picture looks like this. And here's what the income estimate would look like. $50,000 from your portfolio, just from dividends and interest, roughly $40,000 from Social Security if you're a married couple, which totals $90,000 per year. And remember, you have not touched your principal. Now, why does this matter? Why does this work when the traditional model doesn't? This model works because it's built on income, not speculation. Traditional retirement advice tells you to stay heavily invested in the market, sell shares for income, hope the market recovers faster than you withdraw, ignore a sequence of returns risk, and pretend average returns matter. Here's the problem. You don't live on average returns. You live on actual cash flow. If you retire into a bad market like the year 2000, 2008, or 2022, selling investments at lower prices can permanently damage your portfolio. That's what we avoid with this income-based approach. Instead of selling, you're collecting dividends, collecting interest, collecting structured income payments. This allows the principal to remain untouched, and in many cases, it continues to grow independently. You're not hoping for growth, you're designing for income. Now, let's talk about the psychological side. A good income plan doesn't just create dollars, it creates confidence. When you know your income is stable, you travel more, you say yes more often, you help your kids or grandkids without worrying, you sleep better, and you start enjoying today, not fearing tomorrow. And isn't that the whole point of retirement? Most people didn't work 30 to 40 years just to spend the rest of their life budgeting like a college freshman. You deserve better than hope-based planning. Let me give you an example of someone I worked with. Meet David and Susan. They're 65 and 63. Savings had just over $1 million. And their biggest concern was they didn't want to run out of money. And they don't want to lose what they have. Their income goal was about $6,000 per month of spendable income. Their traditional advisor had them at 70% in stocks, mostly mutual funds, and 30% in bond funds. Income? Maybe it was $12,000 a year before fees. The rest came from selling shares. Now, they didn't feel safe or confident, and they were right not to. So what we built instead, we designed their plan around dividend income, structured income, individual bonds, tax-efficient strategies for income, and optimized Social Security timing. Their new plan, investment income of $52,000 per year, add the $38,000 from Social Security, $90,000 of total income, and their principal remains untouched. I'll never forget what David said. For the first time, I don't feel like I have to stare at the stock market to know if we can go on vacation. Now that's clarity, that's confidence, that's control. Now, retirement is a moving target. Your needs change, markets change, interest rates change, tax laws change. But here's the beautiful part. An income-based retirement plan adapts incredibly well over time. When bond rates rise, you lock in higher income. When dividend companies grow, your income grows. When structured notes mature, you reinvest into potentially stronger opportunities. When taxes shift, we adjust your income sources for efficiency. A good plan isn't set and forget. It's set and refine. And because your principal remains intact, you always have options. Now, let me give you my final thoughts on this. You don't need luck, you need a plan. Most people spend decades working hard, saving diligently, and hoping it will all pay off in retirement. But hope isn't a strategy. A structured income plan can give you reliable income, reduces market reliance, builds confidence, and allows you to actually enjoy retirement. If you take one thing away from this, let it be this. Your retirement does not have to depend on the market. It can depend on a plan. If you're sitting there thinking, this is exactly what I've been looking for, but I'm not sure how to build it, you're not alone. Most people only need a clear conversation and the right guidance to get started. If you're near retirement or already retired and you want a plan that helps you spend confidently without touching your principal, make sure to reach out. I'll have a link in the description below for you to set some time up. We'll walk through the numbers, show you exactly what your income could look like, and build a retirement plan designed around clarity, confidence, and control. You've worked hard to earn your money. Now it's time for your money to work hard for you, without unnecessary risk, without guesswork, and without the fear of running out. We can build a plan together. If you like, you can also make sure to subscribe by hitting the button below. That way you can get more videos just like this to help build your retirement plan.